Well, for more on our top line story and for his take on U.S. dollar strength and what it means to the markets, we're joined by Jeff Weniger. He's head of equity strategy at WisdomTree Asset Management and is joining us from his home in Chicago. Hi, Jeff. It's good to see you.
Hey, Paul. Great to be back.
Let's talk, first of all, about our top line story. It dovetails nicely into some thoughts that you've had and that you wanted to bring to our show. But first of all, the rally in crude oil prices this morning on news that OPEC Plus may trim production quotas in a couple of days.
Yeah, well, I guess that's what happens when Brent crude will lose, 30 or 35 points in a matter of 2 or 3 months. I mean, in the summertime, we were in something like the 120s on Brent crude and now south of $90 a barrel. And it goes along with what I've been trying to communicate to a lot of people this year, which is that if you look at, it's not just the oil market, but if you look at base metals, precious metal, in the intro 2 or 3 minutes ago, you were talking about 1674 on gold. Gold was over $2,000 in recent memory. A lot of these metals, fossil fuels and so forth are in a state of decline right now, and OPEC is just pretty much reacting to the reality, which is that what they could get in the middle of the summer is off by, I think it's 30 or 35 points at this point.
You think there's a disconnect between the very strong greenback, which is on everybody's minds these days, and the material stocks in the U.S. and perhaps here in Canada as well? Tell us why.
Yeah, on that matter, just thinking about basic materials relative to the broad market, right? That's essentially what a lot of us do for a living, is try to figure out whether some sector will outperform. And what you find with materials, at least in 2022, that specific sector, it's a tiny sector in the market. It doesn't dominate like tech or something in the United States. But to the extent that the stock market has tumbled 26, 27% year to date, so has materials. Materials have not outperformed or underperformed. They've been an equal performer this year. But when you do a chart of base materials relative to the 500 and overlay it with the U.S. dollar, which, as you pointed out, Paul, the dollar has just been ruthless this year, just a relentless rally against everything, you start to wonder whether or not the materials stocks will start to get a whiff of, a little bit of a deflationary force in some of their pricing power.
The materials include, they do not, that sector does not include the energy producers, but it does include the big mining companies, the big fertilizer players like Nutrien, the gold producers as well. What is your take on the strong U.S. dollar and the energy stocks, the oil and gas stocks?
Well, I think that's what's happened with this move back to double digits in both West Texas Intermediate and Brent crude, and we'll have to see if it ends up continuing to go that way. I mean, one of the things that could be positive for those groups, Paul, is if we end up having the Fed needing to, as far as I can tell, pivot along with the Bank of England. The Bank of England has made a pivot. That is pretty clear and present to me. The question is whether or not the Fed will too. That would take many people by surprise because they're talking out here about a 5% Fed funds rate. And if they do have to pivot, that could be something that's a little bit of a weak dollar story, and then right back into the headlines, maybe right back onto something like $100 Brent crude. The pivot seems plain as day to me that it should be forthcoming, and maybe the catalyst for it is if Credit Suisse decides to stay on the front page of the paper, which has been the case for what, Paul, 4, 5, 6 days now.
By a pivot, you mean the Fed either pausing on its way higher on rates, or in fact announcing a rate cut? What exactly do you mean, excuse me, by a pivot, Jeff?
Pausing, or doing something like just flat out ending the $95 billion QT, the extent that's the monthly rate of quantitative tightening, $95 billion, doing something like that on account of something snapping. I mean, what we have had here was the British pension system did snap, and that happened something like a week ago. And sooner or later, maybe Jay Powell will start to realize that to the extent that he keeps going 50, 75 basis points at these meetings, that it is causing some of these other pockets of the market to end up breaking. So we'll see if we end up having to pivot along with the Bank of England to, it would be the greatest news possible for example, the Europeans, because the ECB is also doing 75 basis points per meeting, and it's just untenable.
Well, what about inflation, Jeff? It's the bank's mandate to tame inflation. There's no clear evidence yet that the U.S. inflation is sustainably on a downward path. How can it pivot with inflation still raging?
Well, when you have critically important banks running along the front page of the paper for enough time, and the VIX in the 30s, and basically everything that you can think of in a state of decline, then those CPI numbers or those PCE numbers are not indicative of the on-the-ground situation. The stock market is off 1,100 points in the S&P. The bond market is in deflation. Crypto's in deflation. Home prices across the United States and Canada are in deflation. They are in deflation in Australia and New Zealand. It's just very near-term deflation after a dozen or so years of all of these things rallying. But in the last, depending on which country you're looking at or which market you're looking at, we have 3, 6, 9, 12 months of the most important things in our lives, houses, stocks, the things that cost big money, in a state of decline. I think that would be the catalyst for a pivot here. In the United States, we have a 6.7% 30-year conforming mortgage. It's unsustainable.